Hello, my name is Troy Eckard. I'm the CEO of Eckard Global. This afternoon what I'd like to do is give you about a 5-minute rundown on where I believe the North Dakota trend called the Bakken is at today compared to where it was 2 years ago in 2015 when the downturn of commodity prices began. First off, a little background. Our company got involved in buying leases and drilling wells up in the Bakken starting in 2010. We've been involved in probably well over 300 wells, 22 operators, and we've seen everything from AFEs, drilling, midstream contracts. We've been involved in recompletions, offset wells, brand new locations, mineral acquisitions. And my point in telling you all this is to simply let you know that the information I'm about to give you comes from a lot of experience and really a strong concentration on one of the most prolific oil fields in the United States. First and foremost, let's just talk about it like it is. The Bakken is the most remote, other than Alaska, oil field in the continental United States. It was discovered as a result of mechanical technology combined with the understanding that a geological formation called the Bakken did in fact have a tremendous amount of recoverable reserves that with this new technology could in fact be released and recovered. So through horizontal drilling and frac stimulation, the Bakken came to life. Back in 2010 and 11, it was almost like the beginning of a wagon train headed west in the United States. It was new, it was undiscovered. Many of the wells were being drilled in remote areas. We were lacking pipelines, we were lacking water supply. It was a long distance from well to well for both rig hands, service suppliers, even municipalities supplying natural gas, food, and restaurants. But what I want to tell you is there's a huge difference from 2015 to today, and in fact the Bakken may be one of the stronger economic plays in the United States, and I can give you a lot of reasons why, and let's go through them. First off, when we were buying mineral leases, in other words, we were acquiring the right to drill a well, in 2010, some of those leases were as low as $1,500 per mineral acre. By the time we got to the end of 2014 and 15, some of those mineral leases, the very same ones, were going for $20,000 per net mineral acre. It's a pretty substantial increase in value. In addition, the cost of drilling wells had jumped from about a $6.2 million estimate. Some of the wells were costing as much as $15 million. When you start putting a percentage of those factors and increases in both land cost, mineral rights, as well as drilling costs, it puts a lot of strain and stress on the economic viability of a Bakken well. A couple other major things occurred. First off, the service providers. The service providers continue to ramp their rates of cost of vendor services as the price of crude oil went up, as if the price of crude oil had anything to do with the cost or the value of their services. Well, in the last 2 years, we've seen all those services come down by 35 to 50%. Many of those suppliers have gone out of business. We've seen the Bakken go from 192 drilling rigs down to about 21 drilling rigs about 2 months ago. Currently, it's running about 42 rigs that are active. The oil companies that were drilling had their teams scattered, drilling 5, 6, 8 wells at a time. So instead of having your best men, your best manpower sitting on one well, making sure it was drilled on time, drilled at the right price, with the right results, and making sure mechanically and from an engineering component, making sure that all things were done correctly, you spread your team out over 5 or 6 wells. So instead of having an A+ result, you were getting C+ and B-. That all changed 2 years ago. They got rid of all the extra rigs. They took their best men off each one of the rigs that were active. They pulled them in from other plays like the Eagle Ford. They consolidated and said, look, this is the gold medal contest for the Olympics. We want every one of our best people in every well. We want them drilled faster, cheaper, stay in zone longer, fracked better, better results. We need higher production output, and we need better reserves per well drilled. Every dollar we spend has to be 3, 4, 5 times better than it was in 2015. Well, that's exactly what's taking place. So let's just talk about just pure comparison. All in between drilling the well, the cost of a mineral acre back in 2010 to 2014 was $10,468 per net acre, upwards of $25,000 to $30,000 per net acre. So think about it. For every net acre, I was spending $10,500 up to almost $30,000 per net acre. Right now, you can go out and buy a net acre in the Bakken based on current cost of drilling and the cost of a mineral lease if you can find a position or want a position to get in for about $6,500 per acre. And that's probably the top end. So what's happened is that although price of crude oil has come down from $95 a barrel, today I believe it's at $50 and some change. So let's say that's just less than a 50% drop in crude oil prices. The cost of drilling has come down by as much as 100%, almost 300% when we were at the peak of drilling cost. Let's talk about midstream. One of the key things that was affecting the Bakken was the fact that we had to transport the crude oil from a state like North Dakota up on the Canadian border down to the Gulf Coast where the refineries and the ships and the processing plants and the customers were located that were going to buy our crude oil. Well, we had very limited pipelines. We had very little ways of getting that crude oil out of North Dakota. We were using a lot of train cars. Warren Buffett owned a lot of those train cars through his different companies. And the fact of the matter, it was costing anywhere from a low of $9 a barrel upwards of $28 a barrel just to ship your crude oil down from North Dakota. Now that same problem doesn't exist. Now the numbers that I've been hearing from the field are somewhere between $2.50 and $5 a barrel because now there is pipelines. The trains are cheaper. There is more ways of getting crude oil out of the state, and there's less oil to move because now we only have 42 rigs that are drilling. So all in all, here's my assessment of the Bakken. I still think it's one of the most attractive investments in the country for the investor. I get high net revenues. I get to drill with the majors. I get forest pooling, which means I get the same rights if I own 1 acre or if I own 1,279 acres. I get the same right for distributions based on the price I get paid for my crude oil, the same as the major oil company. They handle all the midstream contracts. I get the right to offset my own wells. Everything that's on that lease, I get first right to participate because it's my lease. And so I think at the end of the day, I would say that the Bakken is probably better today than it was even 2.5, 3 years ago by a long shot. My experience is 35 years of drilling oil and gas wells in about 7 different states, hundreds if not thousands of wells being drilled and participated in. And I want you to think about the companies that are in the Bakken today are getting a better bang for their dollar than they were even 2 years ago. I like the Bakken. I want to be in the Bakken, and I think it has a lot of opportunity. My name is Troy Eckard. I'm the CEO of Eckard Global. Hope you have a fantastic week. I appreciate your time. God bless America. Thank you.